Did you get sucked into the trap? Did you buy theoretically at the wrong time? Are you having buyer's remorse? Do you own a home, or at least are on the path to home ownership, which is more than likely roughly 30 or more years away from actually being a reality more than a dream? And you're wondering to yourself, how did I get here? And more importantly, how can I get out of here quickly, fast, and in a hurry? Well, to be honest with you, most people aren't necessarily born rich and have an endless supply of money where they can go out and purchase a home, whether it be $300,000, $400,000, $500,000, $1 million or more, and pay cash without having to carry a mortgage or a loan or balance on it and make payments every single month. But that doesn't have to be a bad thing. It just is what it is. And ultimately, how do we solve this problem and relinquish ourselves from the clutches of the bank, and ultimately money being stolen, taken away, wiped out of our bank accounts through pesky interest? Now, the beauty of home ownership is the fact that theoretically you have gotten in to an appreciating asset, which is typically what a home is considered a primary residence, more so an investment property, but we can talk about that a little bit later. And the key with being profitable in real estate is you make your money when you buy, okay? Now, I would say that a lot of folks who have bought here recently probably are questioning whether or not they're going to make any money. But realistically, if you've purchased a home in the last 12 to 18 months, maybe 24 months time, and you didn't plan on living there for at least 10 years, then yeah, you may have bought at the wrong time. But with that being said, depending on the condition of the home, the location of the home, your plans for the home, well, then there's still a possible upside for you in the form of profitability in making gains. However, if you own your home, and even if you've owned your home for several years and you're looking at how much money you're paying, essentially throwing away to interest to borrow money, hundreds of thousands of dollars more than likely from the banks to finance this property, then you're probably asking, wondering, maybe even searching, which is how you came across this video, of how do I get ready to free myself of this burden hanging over my head and ultimately pay off my mortgage sooner, pay it off faster. And folks, I gotta tell you, these are all great questions to ask, and honestly, very, very simple and easy answers, which I actually have 6 for you that I'm gonna share with you. Obviously, the easiest one would be to just pay it off, which is not part of my 6. But in order to do that, you're going to need a substantial amount of money more than likely. And if you're interested in finding out ways in which you can earn more money, then by all means, let me know, because these are conversations we can have. Definitely coming into substantial amounts of money in short periods of time would essentially make it much easier for you to eliminate your mortgage, okay? We get that. However, making more money will also be very, very helpful in not only the six how-tos I have here on how to pay your mortgage off faster, but also on how to just, manage your life and living expenses and budgeting and everything else on a daily basis. So let's just jump right into it, with number 1 being refinance, which obviously no brainer. If you're paying a mortgage and you're seeing a ton of your payment going towards interest versus principal, or in lieu of principal or instead of principal, then it would be most advantageous to get your interest rate down as low as possible. However, with that being said, easier said than done, especially considering the economic situation and climate that we are in today. That could change over time, as I'm seeing and hearing talks of the Fed discussing lowering interest rates in 2024, so get ready. However, there are costs associated with refis, and odds are you're probably not going to get an interest rate down below 2% anytime soon, if ever again. So lowering your interest rate could be very, very helpful, especially if it's really, really high. But then you have closing costs and appraisals and attorney fees and things like that that go into it. But a refinance could be a great option. And if interest rates decline, then you may be able to reduce the amount that you pay toward interest by refinancing your mortgage. And additionally, you may also elect to reduce your loan term significantly in this refinance period. So if, let's just say, for instance, we see a reduction in interest rates and you refinance, you could refinance the remaining balance at a lower interest rate, possibly even putting down a lump sum to lower the principal balance, while also reducing the term, which means that you're paying interest over a shorter period of time. This will definitely, the reduction in the term length, increase your payment, monthly payment, but also a lump sum payment would then reduce your monthly payment. So these are options to weigh. Number 2, make extra mortgage payments. Simple as that. Another way that you may be able to save money on interest while reducing the term of your loan is to make extra mortgage payments. And if your lender doesn't charge a penalty for a prepayment penalty for paying off your mortgage early, considering the following early mortgage payoff strategies may prove to be beneficial to you to pay your mortgage off faster. And just remember that it would be wise to inform your lender that your extra payments should be applied to principal and not interest, okay? Otherwise, your lender might apply the payments towards future scheduled monthly payments, which won't save you any money. And ultimately, that's what we're trying to do. We're trying to forego and bypass this expense of interest every month. Also, try to prepay in the beginning of the loan when interest is the highest. You may not realize it, but the majority of your monthly payment for the first few years actually goes towards interest and not principal. And interest is compounded, which means that each month's interest is determined by the total amount owed, principal plus interest. And what you actually get is an amortization schedule that shows you this. And 360 payments theoretically over 30 years. You see payment number 1, interest is really high, principal is really low, and let's just say payment 180, which is not really how it works, is like, equal 50-50, and then as you get closer to payment 360, you're paying very little interest and it's going towards principal as you make that final payment. But the amortization schedule can actually show you that, and if you'd like me to show you a breakdown of your amortization schedule for your mortgage and what you have remaining, then by all means, reach out, hit me up, let me know. Number 3 would be to make just one extra mortgage payment each year. So remember, these extra payments, you got to tell them it's for principal, okay? Because they understand, the banks, the mortgage companies, the lenders, the brokers, they want to make the money on the interest. They don't make money any other way, really, for the most part. Granted, late payment fees and penalties, they make a little bit, but they would rather not have a delinquent and possible high-risk borrower racking up those fees. Instead, they would rather have their money on time and earn their interest and then take that money and reinvest it in other ways that they are going to make more money on it. So number 3 is making one extra mortgage payment each year, and making an extra mortgage payment each year could ultimately reduce the term of your loan significantly. There are actually calculators that can show you how this would be, how much of an impact this would have over the life of your loan. So if you'd like me to show you that, let me know. The most budget-friendly way to do this is to pay, basically take your payments and divide them by 12, basically. So take your monthly payment. If your monthly payment was, let's just say for argument's sake, $3,600 was your mortgage payment, you divide it by 12, and now you're at $300. Okay, so if you make one extra mortgage payment each month, or I'm sorry, each year, then that would just be another $3,600, and you would have paid the equivalent of an extra payment that you could break up every month by paying $300 a month. So the goal is to pay another $3,600 every year, which is one extra payment. So you don't have to do it in one lump sum. You can do it every month by just paying $300 extra per month to equal the $3,600 at the end of the year. Let me know if this makes sense, okay? Maybe I should use some charts and some graphs and some figures here and some editing tricks to show you the numbers and the math, but just let me know. Number 4 is an easy one here, and it's actually what they do at the grocery stores, I think. Do it at the grocery stores, and some banks do it on debit card transaction, and it's basically rounding up. So rounding up your mortgage payment, and this can help to reduce the term of your mortgage significantly by rounding it up. And if you budget your monthly mortgage payment and you round up to the next highest, let's just say a $100 amount, you could be paying, for instance, $800, which if you have a mortgage that's under $800, this is good news to hear, especially where we're headed next year. But pay $800 instead of paying your mortgage payment of $743, or $900 instead of $860. So basically, just round up. Every little bit helps to chip away. Remember, how do you eat an elephant? It's a big animal, right? One bite at a time. But the key is that when you do this, you let the mortgage company know this extra is for principal, okay? Because the interest is compounded based on the remaining principal balance, you want to chip away at that principal, okay? Number 5 would be to try the $1 a month plan. And the $1 a month strategy should be financially feasible for pretty much anybody if your income increases slightly but consistently over time. And basically each month, if you increase your payment by $1 each month, and you simply pay, let's just say $900 for the first month, $901 for the second month, and $902 for the next month, and so on and so forth, over that 30-year, $900 per month mortgage with, let's just say, roughly a 6% fixed interest rate on a loan of $150,000, you could reduce the term of your mortgage by 8 years by simply paying $1 more than you did the month before each month, okay? And this one's pretty easy and simple to keep up with and keep track of. So, maybe cut back on some Starbucks, cut back on some avocado toast, cut back on a few splurges here and there just to pay an extra $1. And then in 22 years, your mortgage is paid off instead of 30, and you're going to be very, very happy that you have done that. Lastly, number 6 would be to use unexpected income, okay? Now, granted, you can't bank on unexpected income. I know a lot of people bank on tax returns and money coming in like that, birthday money, but you can't necessarily bank on it. But if you got it, if you get it, it could go a whole lot further going towards your mortgage and your principal balance, especially if you have a higher interest rate. But basically sending in any unexpected windfalls straight to your mortgage company, making sure they know it's to be applied towards principal, not interest. And this includes holiday bonuses from your job, tax return money, credit card rewards that you receive as cash back, using money that won't cut into your regular monthly budget, but just any extra money that you weren't expecting. Just block it out of your mind, pretend like it's not even there, and just put it towards your mortgage. And these are the benefits, or these will work towards the benefits of having paid your mortgage off early. Because simple enough, many people struggle when deciding whether to pay off their mortgage or build up savings. Rightfully so. But in the long run, in my opinion, the benefits of getting free from the mortgage really kind of take precedent over savings, okay? Depending. This is all depending. For one, having one debt paid off, a huge debt being a mortgage and a house, means being able to handle any short-term debts such as credit cards. And also you got to think, if your mortgage payment is hundreds, thousands of dollars, the sooner it's paid off, the sooner you have that money available for savings, okay? You also end up saving money if you pay off your mortgage early, because you've avoided the additional interest that would have otherwise accrued, making your saving strategy even that more effective. And your financial stability is definitely going to be further supported by cutting out these future payments, and also by your ability to better endure turbulent housing market conditions, okay? 2024, we don't necessarily know exactly what we're heading into and what we're up for, but I can more than likely be willing to bet that it's going to be challenging, especially as some folks are now discussing and talking about how they regret the purchases and have buyer's remorse of buying homes or selling properties, or getting out of cheaper, lower interest mortgages and into higher interest mortgages, because they were looking to capitalize on the equity gain on their property in the turbulent times of the housing market, and avoiding the housing market crash, or this reverse housing market crash. So I would say that, me personally, I would make sure, obviously, I have my safety net in place, but beyond that, saving over and abundant while also carrying a mortgage, I would then be focusing my sights and attention on chipping away at that, especially if my interest rate was over 5%. If my interest rate on my mortgage was over 5%, I'm definitely looking at that, because where am I going to get a greater return than 5% anywhere else consistently, right? So if you said, oh, well, my mortgage is 6%, 7%, depending, but I can get 12, 13, 14, 15, 20, 25% return somewhere else, then by all means, take that money and put it in another investment vehicle that's going to bring back substantial returns over paying off this mortgage just to, get out of this 7% interest rate. But I can pretty much guarantee that most people don't have that investment opportunity presented to them to take advantage of that. But also, I would have to then look at it from a standpoint of, well, no risk, no reward. And in order to get a huge reward, like let's just say a 25 or 30 or maybe even a 50%, or maybe doubling your money 100% return on investment, well, that risk would have to be relatively high to make that even a realistic, feasible possibility, if that makes sense. This is just a little bit of a high-level overview discussion of, answering some questions that I get often, really, but more so here recently, given the current situation that we're in, and the headlines that you see in the news, and the things that people are saying and talking about, and the changes in people's household budgets and their household balances, and the economy in general, thoughts, ideas, worries, concerns, speculation of the future, and something as important as home ownership, as important as the asset being real estate, and as important as saving money and not wasting any, and sending or spending or paying as little as possible towards interest that you really don't get anything for. Now, if we were to make this argument in comparison with buying versus renting, well, renting, there's no principal, there's no interest, but you have no ownership, basically. You're just borrowing it. But the cost is actually relatively less, and there's no down payment requirements. The maintenance and repairs are not on you, so there's little to no unexpected surprises and financial emergencies. The insurance is not for you. You don't have to cover that. So depending on who you are, and depending on your lifestyle and your financial situation, and also your timeline and your future goals, well, renting may actually be better than buying. But at the end of the day, you got to weigh these out. You got to run the numbers. You got to do the math, and you got to make the best decision that is going to work out for you and your family. But like I said, if you guys want to have these conversations, then by all means, feel free to reach out to me. And if you want to know how you can make money online, working remote jobs, side hustle, passive income stream, saving and investing, Again, my info is in the description, so hit me up. Let's have a talk. Let's have a chat. Until next time, you guys take care. Be safe. I'll see you real soon. Okay?